Okay, let's take a quick run through for Chapter 11. So Chapter 11 talks about partnerships. We start off just talking about, some technical information. A partnership is formed when two or more people get together. They enter into a partnership contract. A partnership has a limited life. The profits from a partnership are taxed personally, so the partnership itself is not taxed. It's the profits are taxed in the hands of the owners. Co-ownership of property, so all assets are jointly owned. So as it states here we go. Partners have a claim on partnership assets based on the balances in their capital accounts. Then they talk about mutual agency. So what this means is each partner is a fully authorized agent of the partnership. As an agent, a partner can commit or bind the partnership to any contract within the scope of the partnership's business. So as long as it's within the scope of your business, then one partner can act on behalf of the other partners. Now that's either knowingly or unknowingly. So one of the partners can decide to enter into a contract or do something that commits all partners, even if the other ones were in disagreement about it. So it's something you have to watch out for there. Be careful who you enter into partnerships with. They can agree to limit the power of one of those partners, but it's only if the outsiders know it exists. So if you were to limit the power of one of your partners, then you would have to make it known to the relevant parties so that they know that this person can't enter into contracts for you. Unlimited liability. So if there's any kind of debts to be paid, creditors can come and go for your personal assets. If one partner can't cover their share, then the creditors can actually look to the other partners for that remaining portion that's not covered. So therefore, that's why they say there's unlimited liability, because it's more than just what you invested. They can come after your personal belongings. They give Exhibit 11.1, which has advantages and disadvantages of partnerships. Take a read through those. They're easy to start up, generally have low startup costs, access to more capital sources. That's because there's, if it's a proprietorship, generally it's only the one owner that is contributing, but because there's more than one, there's a few owners, a few people that they can contribute. Sorry, there's a broader base of management talent, because again, there's more than one of you, so you might have different skills. You're sharing the risk, but unlimited liability for general partnerships, again, that they can come after your personal assets. It might be hard to find a suitable partner. It's going to have to be someone that you trust, because they can enter into agreements on your behalf. There could be conflict and disagreement, and they can legally bind each other without prior approval, and there's a limited life. Okay, then we get into limited partnerships. There are two kinds of limited partners, or two kinds of partners, I should say, general and limited. So in any partnership, there has to be one general partner, at least one. There could be more, but at least one has to be a general partner. And that's the general partners. They take part in the management of the company, and they have unlimited liability. So, which means for all the debts, so that they could be gone. Someone could go after them personally. Whereas a limited partner, they are only risking the amount that's invested. You can't go after their personal assets. They can only lose the amount that they've invested into the business. Also, they can't take part in the management of the business. And then there are limited liability partners. You'll often see that when it comes to lawyers and accountants. Limited liability partnership, it's often referred to as LLP. This is is meant to protect the people. So that's why you'll see it more in for lawyers and accounting firms. It's to protect them for malpractice and negligence. So if one of the partners does something that results in, for example, a malpractice claim, you could only go after that one person for that particular claim. Other general items are the same as a general partnership or limited, where there's unlimited liability. You can go after the partners for the remaining general debts of the organization. But if it's to do with malpractice, something that one individual has done, then it stays with that one partner. So now let's get into the accounting part of things. So it's accounting for a partnership is essentially the same as for a proprietorship, with one major difference, and that's the equity, anything affecting equity. So a partnership accounting, they use a capital account for each partner, whereas a proprietorship would just have one. They use a withdrawal account for each partner, and again, a proprietorship would just have the one. And they allocate profits or losses to partners according to the terms of the partnership agreement. Okay, so first step is organizing a partnership. So when they invest in the partnership, we credit their capital accounts for the amount that they invest. Now they can bring both assets and liabilities to the partnership. So the example they give us here, January 11th, so Olivia and David organize a partnership called the Landing Zone. We don't need to care about what they do. So the net investment. So Olivia's investment is $30,000, made up of $7,000 in cash and equipment with a fair value of $33,000, and a $10,000 note payable reflecting a bank loan for the business due in 6 months. David's initial investment is $10,000 cash. So we have to record their entries. So for Olivia, it was $7,000 in cash. So we debit cash. Equipment with a fair value of $33,000, so that's debit to equipment, and a $10,000 note payable. So we credit note payables $10,000. So her capital, the net of all this, so 33 and 7 is 40, less the note payable of 10, which leaves us 30. So she has a $30,000 investment. Where's his? His initial investment of cash of $10,000. So debit cash, credit David's capital account. So that is the entry that records their initial investment. Then we look at their balance sheet. So it's a typical balance sheet, your assets, your liabilities, but it's the equity side. There would be a capital account for each investor, each one of the partners, and we would just show the balance, $30,000 and $10,000, to show their total equity. After the partnership has been formed, then again, all of the entries are very similar to a proprietorship, except partner withdrawals of assets are debited to their individual withdrawal accounts, so there's going to be more than one as opposed to a proprietorship. In closing the accounts at the end of the period, each partner's capital account is credited or debited for their share of the profits, as opposed again to one account for a proprietorship, and the withdrawals account of each partner is closed to that partner's capital account. So it's just basically that there's more than one is the theme here. There's more than one, just one for each partner. Okay, so let's look at how we divide profit or loss among the partners. So there's a couple of terms that I want you to be aware of. Salary allowances. So you can allocate part of the profits, for example, through a salary allowance. This is an amount that's agreed upon ahead of time. It's written into the partnership agreement, and it represents an allocation of profits. It's not actual cash being distributed. So it's indicating that partner A would receive a salary allowance of, just for example, 50,000, and partner B would receive a salary allowance of 40,000. It's representing how much salary because they don't get a salary, they're owners. So it just kind of represents how much they should respectively get in of the profits. Then there are interest allowance. This is a return of the amount that they've invested. So it's generally done as a percentage of their beginning capital balances at the beginning of that year. So it could be, the partnership agreement could state that they get 10%, they earn 10% of their beginning capital balance of the year, or whatever percentage they want, but a certain percentage of the amount that was in their capital account at the beginning of the year. Again, it's not a cash payment. It's not an actual distribution. It's just a way of allocating. So they can agree to any method they want for dividing and allocating out profits or losses. They can do whatever they want in the partnership agreement, but if there is no mention of it in the partnership agreement, then the law states that it gets done equally. And the other side of things, if they say this is how we're going to share profits, but they don't mention losses, then losses get shared in the same way as profits. So next we're going to look at 3 methods that can be used. So there's a stated fractional basis, the ratio of capital investments, or salary and interest allowances and any remainder in a fixed ratio. So there's 3 ways that the profits or loss can generally be allocated out. So we'll take a look at these now individually. So the first method, allocated on a stated fractional basis. So here is when they allocate them out based on a fraction of a total. So partners have to agree in advance on what portion, what fraction they receive, each partner receives. It can be done as a ratio, a fraction, or a percentage. They can state it how they want. But for example, the one they give here, it's assume a 3-to-2 ratio. So then what you do is, so one person would get, I guess the best way to explain it is you add these two together. It's 3 and 2 is 5. So one person would get 3/5 and one person would get 2/5. And they kind of show you here. So 3/5 and 3 divided by 5 is 60%. And the other partner would get 2/5 or 2 divided by 5, which is 40%. So any profit that's left, one person would get 60%, one partner would get 40%. So you can express it that way, as a ratio, a fraction, a percentage, however you want, and then you divide the profits. So we're going to look at, for example, if it was Olivia and David, and they had a 3-to-2 ratio. So again, 3-to-2 means 3/5 of the profits, or 60%, would go to one partner, and 2/5 of the profits, or 40%, would go to the other partner. So here they say there's a $70,000 profit. So we're going to do the entry allocated to the partner. So we're going to close out our income account here and allocate it to the partners. So we're going to debit our income summary, the full 70. And then the portion that each partner receives, again, Olivia receives 60%, and David receives 40% of the 70. You can allocate it based on a ratio of their capital investments. So again, if we look at the 2 partners, they share their earnings on a ratio of their beginning capital investments. So there was a $30,000 investment and a $10,000 initial investment. So that means how you find the total there is 30 of the 30,000 of the total that was invested, which was 30 plus 10, so that's 40. So 30,000 of